Hello guys, my name is Moshir Ansari and today we are going to analyze Sigachi Industries. So we are going to analyze its fundamentals and technicals. So let's start with its technicals. Okay. So as we can observe that when the stock was launched, it was a crash, and afterwards it has boom by the around. It has given the return of 250, and afterwards it is crash again and about 60 68%. Now it has we can say that at this level it has taken the support around this area of 30 rupees. Now it is booming again, right? So basically currently the stock is up by the around 50% from it is lowest point. So it is a quite very big upside move. As we can see that is a very big candle, green candle, right? So basically if you compare with his all-time high, it is at very cheap price currently from 90 to 94 to 30 44. That's great. If the fundamentals comes right, then it is a good stock to buy now, right? So let's start it is fundamentals. So basically as we can see that the market cap of the stock is 1600 crores. So basically it is a small cap, or we can say tiny cap too. So basically the company is incorporated in 1989. Sigachi Industries Ltd manufacturing and selling of MCC. Business overview, SIL is one of the largest manufacturers of cellulose of I am not able to pronounce this cellulose based extraction. The company manufactures MCCC in nutraceutical grades ranging from the 15 microns to 250 microns with over 60 products. The company is in the business of active pharmaceutical ingredients, intermediates of pharmaceutical essentials, vitamins, minerals, blends, polymers, blends, food, nutrition, operation and management services. So basically the company makes the pharmaceutical products, but they are not like a complete pharma. It is initial product. Means if you want to make a Dolo 650, it requires cereal ingredients, right? So those ingredients is made by the Sigachi Industries. In simple words, we can say that, right? So let's go with it is ratio analysis. So basically stock is at 22 and the industry is 33. That's so it is quite undervalued. Return on capital employed and return on equity is quite low, and promoter holding is 44, and change in promoter holding, it looks like promoters are heavily selling. We have to watch the shareholding pattern over the years, right, for that, in order to come to the conclusion. Interest coverage ratio 8.64, that's quite low. Not low, that's good. Okay. As the debt to equity is 0.24, that's great. Okay. EPS growth for the 5 years is minus, that's very bad. Quick ratio is 1.62 and current ratio 2.13. That shows that the company has inventory in their stock. Plus 45.4%, that's very bad red signal for the company. Current price is 44 and the book value is 15.7. It means price to book value is 2.81. Okay, accept it. Sales growth for the 5 years 28.6, quite good. And the face value is 1. EV to EBITDA is 14. It is not good if you look at if you compare all the ratios. It is quite high for the company. Industry PEG ratio is 1.09. It is quite good. Industry price to book value is 3.47, where the stock price to book value is 2.81. That's quite good. But overall, the ratio is showing that the company is not doing well. Okay, so let's check the PE and EPS growth over the years. So as we can, Jan 22 22 P was 10 and the EPS was not given. So Jan 23 P was 20 and the EPS was 1.55, right? And Jan 24 the P was 45 and the EPS is 1.4. That look like EPS was going down. And Jan 25 P is 25 and the EPS is 2.01. That's quite high. And currently the PE is 20.5 and the EPS is 2.16. That shows quite company is quite undervalued if you do trend analysis of PE and EPS. Okay, quarterly results. That's what the quarterly is. As you can see that the company is doing very good sales quarter on quarter in double digits. It is quite very good. And operating profit sorry for that. Material cost, as we can see that company is not able to reduce the material cost. It is quite fluctuating. As you can see, they are able to. There is their employee cost still. Their employee cost is also very fluctuating. As we can see, from 9% to 17% to 15%, then again 15%. But still, they somehow able to manage operating profit margin of around 20. As you can observe, it is also fluctuating, but on an average, it is 20. They have very less interest obligations and depreciation too. Net profit in from June 22, that is they were having a net profit of 13 and now they are having 16. That's quite we can say around improvement of 14%, we can say. Sorry, 30% we can say, 30 or 25%. That's not quite good within 3 years. It is a pharmaceutical company, it should grow very fast, right? Sales growth, as we can see, profit and loss down year on year, we can see it is growing very fast from 130 to around 500. That's very great. And operating profit margin is remains same around initially they were having low operating profit margin, now they have around 20%. That's great. Interest obligation is still low. Net profit is from 70 to 70, that is 10 times within 7 years. That's great. Balance sheet, as we can see that initially they were having a equity share capital of 3 crores. Now as we can see, it is increasing year on year. That shows that promoters are diluting their shares, their ownership in the company, and the reserves in the company has been increasing exponentially. That's great. Borrowings, as we can see, the long term borrowings is quite low, acceptable, and short term borrowings are high. That's good. It is short term borrowing. They don't create any major problem for the company. But still, as we can see, it is continuously increasing from 25 to 180 because of maybe they are doing some capex. That's why maybe. Yeah, right. Because see here, fixed asset they have purchased from. They are gone from 262 to 260. We can say around 10x. That's a huge capex. They are doing very huge capex. The capital work in process is in 100 crores approx. That's great. They are doing excellent. Cash flows, as we can see, within 3 years they are able to generate around 40 and 40 and 30 17 crores. They have collected 17 crores. What sales they have done? They have done 15, 120, 20, around 200 and 210. 210. Basically, they are not able to collect the cash. They are just doing credit sales, which is not good for the company. And fixed asset, as we observed that they are continuously buying the fixed asset. That's good. They are also purchasing investment here, as you can see that. They are also raising their proceed from the share, as we observe that they are selling their shares. proceed from the borrowing. That should be like short-term borrowings. Everything is look good except they are not able to generate the cash, collect the cash. Sorry. And debtor ratios, debtor days, basically as we can observe that the debtor days is increasing. That's not a good sign. Inventory days also increasing. They may be producing more products that they can sell. So basically they have more inventories now. Days payable, we can say a little bit increase, not that much. This leads to the cash conversion cycle is been not 234 days. That's too much. Means their net working capital is stable in the business for the 234 days. That's very bad sign for the company. Shareholding pattern, as we can observe that the company shareholding has been, promoters are continuously selling their share in the company around the years, and FII is recently increasing their stake in the company. That's good sign. Uh, there is no DIS, public hold shareholding has been increased. Basically, the majority of the shares is held by the public. That's quite concern. That's great concern for the company. Let's see if there is any resignation happened in the company. Resignation of the direct appointment of the mutual general. It was happened in 2024. That's not a major concern now. So basically, overall, the company is not doing well. They are not able to collect the cash. They are not able to generate more sale. They are not able to efficiently manage their cost, which leads to they are stuck with the same operating profit margin. So basically, they have to improve their sales. They have to increase their volume of the sales so that they can increase the profitability even without having the same operating profit margin. So for now, my suggestion is that to closely watch this stock. As it shows that it is having a low PE if we consider the history of the company, but still the stock is not doing well. That's why the market is not pricing the stock high. So for now, just watch the stock. Don't buy this stock. Thank you very much. Have a nice day.